Welcome back, viewers. So, in previous session we have started with dividend decisions, wherein we have seen the introduction of dividend decisions, dividend policies. We have talked about relevant and irrelevant models of dividend decisions. We have started with the relevant model and we have discussed Walter model. We have also seen one example of Walter model. So, we will continue in this session with the next model, which is relevant model of dividend decision, that is Gordon's model. So, this model was developed by Myron Gordon, and Gordon's model explicitly relates the market value of the firm to dividend policy. There are certain assumptions of Gordon model as well. It says that the firm is all equity firm. So, there is no other source of finance for the firm and the firm is all equity firm. So, there is no debt and no external financing as well. The return is constant, the cost of capital will also remain constant. The earnings are perpetual and there will be no corporate taxes. The retention ratio will also remain constant and cost of capital is more than growth. Okay. Keeping these assumptions in mind, this is how the Gordon model looks like. So, according to Gordon's dividend capitalization model, the market value of a share is equal to the present value of infinite stream of dividends received by the shareholders. So, this condition can be represented with the help of this equation which is presented on the screen, where price of the share is equal to dividend declared at the end of first year converted into the present value of terms by dividing it with 1 plus k, plus dividend declared in the second year, again converting into the present value terms, and similarly we will convert all the dividends which are declared in infinite in present value terms, and this combination, this value will give us the present value of our share. Okay. This particular equation can be summarized or can be presented in the form of right hand side of the equation, which says that summation of this equation, that is dividend declared till time t divided by 1 plus k raised to the power t, and summation of all the values which are presented here. But the dividend per share is expected to grow when the earnings are retained. So, the dividend per share is equal to the payout ratio. Here payout ratio is equal to 1 minus b. B is retention ratio. 1 minus b times of earnings per share, which is represented with EPS. So, this thing can be represented in the form of equation like this, where our div at time t is equal to 1 minus b multiplied by EPS on time t. Okay. So, b here is the fraction of retained earning or the part of retained earning, 1 minus b. It is assumed that the retained earnings are reinvested within the all equity firm at the firm's internal rate of return. This allows earnings to grow at G. G is the rate of growth, which is equal to B multiplied by R. And this amount is calculated per period of time, like per year or per quarter or semi-annually, the way you want to use it. So, when we incorporate growth in earnings and dividends, it resulting from the amount that is resulting from retained earnings in the dividend capitalization model, the present value of a share is determined by the future dividend, which grows at the constant rate. And this can be presented with the help of equation which is visible on your screen. Now, by solving this equation, we will reach to this formula where our P, price of share, is equal to div, dividend declared at the end of first year, divided by k minus g, where k is cost of capital minus g, g is growth rate. How we will calculate div 1, dividend declared at the end of first year? So, div 0, that means dividend declared today, has to be multiplied by 1 plus growth rate. This will give us the value of dividend to be declared at the end of first year. By putting this value in our equation, we can calculate the expected price of share today. So, future dividend, expected future dividend will decide or will give us the value of expected price of share today. By using these equations, the formulas that we have discussed, we will get the formula for Gordon model as well. So, by substituting EPS declared at the end of first year multiplied by 1 minus B for DIV1 and BR for G, B into R for G, we will get the formula for Gordon model, which is equal to according to Gordon model, the price of the share is equal to EPS declared at the time period 1 multiplied by 1 minus B, B stands for retention ratio, divided by K minus BR. Okay. So, this formula can also be presented like the equation which is given on the lower side of this slide, where BR is replaced by G. Now, let us try and understand the Gordon model with the help of one equation. The equation is there on the screen. Here EPS is given as rupees 10, K is 10%, R is 15%, 10% and 6%. So, again we have 3 cases like we have discussed in the case of Walter's model. Here the payout ratio is 40%, 60% and 90%. That means we have 3 cases for payout ratio as well. So, in all we are going to calculate price of the share 9 times. That is, for R as 15%, we are going to solve it for payout ratio 40%, 60% and 90%. Then for R 10%, again 3 cases of payout ratio, and when R is 6%, again 3 cases of payout ratio. By using this value, we need to capture the effect of dividend policy on the market price of the share using Gordon's model. So, again the question is presented in the form of this table. Again, on extreme top left side corner, these values will remain common for all the scenarios, where our K is 10%, which is written as 0.10 here, our EPS is rupees 10. There are 3 cases, 3 types of firms in each column, where R is greater than K, the case of our growing firm or growth firm. R is equal to K, that is our normal firm, and then when R is less than K, our declining firm. So, all these scenarios will be tested on 3 parameters or 3 situations of payout ratio. The first case where payout ratio is 40%. So, if payout ratio is 40%, our retention ratio will be 60%. Second case, when the payout ratio is 60%, and if the payout ratio is 60%, then the retention ratio is 40%. And third case, when the payout ratio is 90%. In this case, our retention ratio is 10%. So, we will see that how we are going to use our formula to calculate the price of the share under Gordon's model. So, first of all, we are going to calculate it for cell 1. Is the same equation or the same formula for Gordon's model that we have seen previously. By placing the values given in the question in the formula, we will replace EPS as 10 brackets 1 minus 0.60. 0.60 is our retention ratio. It is the case 1. Okay, we will close the bracket and we will divide the whole equation by 0.10, 10% minus 0.60 multiplied by 0.15, which is 15%. Okay, your growth rate, which is equal to B multiplied by R. So, B is 60%, R is 15%. We have placed these values in the equation, and by solving this equation, we will get the value of P, which is rupees 400. Now, we will place this value 400 in our table on the first cell. So, you can see that first case where R is greater than K, R is 15% and payout ratio is 40%. In first case, our price of the share is 400. Using the same equation, we will solve it, we'll insert the values in the equation to calculate the market price of the share under different scenarios, under different situations, and we can fill the columns using the values that we are getting after solving the equation. So, from this we can see that in first column, which is a case of growth firm, we can clearly see that when we are increasing the payout ratio, the price of the share started falling. Okay. So, when the payout ratio is 40%, the price of the share was 400, but when the payout ratio is 90%, the price of the share falls to rupees 106. In the third column, which is a case of declining firm, when the payout ratio is 40%, the price of the share is 62.5. But when the payout ratio has increased to 90%, the price of the share has also increased to 95.74 rupees. So, this is the case of declining firm. When we are increasing the payout ratio, the price of the share is also increasing. But in middle, the case of normal firm where R is equal to K. So, whatever our payout ratio, whatever our retention ratio, it is not going to impact the price of the share, and it is seen in this table in the middle column that the price of the share is rupees 100 in all the 3 scenarios of payout ratio. It is not changing at all. So, once again, just like Walter's model, it is proved by Gordon's model as well that declaring dividend impacts the price of the share in the market, and when the payout ratio is increasing, so in case of growth firm, the price of share will fall. In case of declining firm, the price of share will increase, but in case of normal firm, it is not going to be impacted at all. Okay, so this is the conclusion of Gordon's model. Okay, moving ahead to the third model of the day, Modigliani-Miller hypothesis. This is the first irrelevant model of dividend policy or dividend theory. So, according to Modigliani and Miller, under a perfect market situation, the dividend policy of the firm is irrelevant as it does not affect the value of the firm. They argue that the value of the firm depends upon the firm's earnings, which results from its investment policy. Therefore, when the investment decisions of the firm is given, the dividend decisions, the split of earnings between dividend and retained earning, is of no significance in determining the value of the firm. Then there are certain assumptions of hypothesis as well. It says that it has perfect capital markets. Okay. Perfect market is a situation where we have multiple buyers, multiple sellers, the information is available to everyone. So, the same scenario or the same conditions of perfect market is applicable to perfect capital markets as well, and this is primary assumption of hypothesis. There are no corporate taxes, company follows fixed investment policy and no debt financing at all. There is no risk, and shareholders are indifferent between dividend and capital gains. So, they do not know, or they are confused, or they do not have any kind of preference whether they are getting amount in form of dividend or in terms of capital gains. So, keeping this assumptions in mind, Modigliani-Miller proposed this equation for calculation of market price of share, where the present price of share is equal to D1, that is dividend declared at the end of first year, plus price or expected price at the end of first year divided by 1 plus k. We are dividing it to convert it into present value terms, because we are using D1 and P1. These are the expected values that we may get at the end of first year. By solving this equation, we can get the value of P1 as well. Okay. By just solving the same equation, we are calculating the value of P1. That means we can calculate the expected price of share as well in future. So, our P1 will be equal to P0 multiplied by 1 plus k, and we have to subtract dividend to be declared at the end of first year, and using this we will get the value of P1. Let us see, or let us understand hypothesis with the help of this example. So, a company is planning to invest rupees 10 lakh and it expects to earn rupees 5 lakh by the year end. Okay. So, expected earnings are given as 5 lakh. Presently, the company has 50,000 outstanding shares and the share of the company is trading at the price of 125. The company expects to pay the shareholders rupees 10 as dividend next year. So, the dividend to be declared next year, that is D1 is given. Present value of share price is also given, that is 125 rupees. The company's required rate of return is 15%. Now, keeping these things in mind, we need to find out the value of the firm when the dividend is declared. Also, we need to calculate the value of the firm when the dividend is not declared. So, let us see this situation one by one. So, in first case, when the dividend is declared, the price of the share at the end of first year will be equal to this is the same equation. Okay, we are just placing the values in this equation and here P0, price of the share today, is equal to 125. This has to be multiplied by 1 plus 0.05, 15% is rate of K, minus dividend that is expected to be declared at the end of first year, that is rupees 10. Now, by solving this equation, we will get the expected price of share at the end of first year, that is rupees 133.75. So, this is the case when the company is declaring dividend. So, in case the company is not declaring dividend, the price of share at the end of first year will be equal to rupees 143.75. We have just placed the same values in the same equation, with the only difference that the D1 will be 0, because in this case no dividend will be declared. So, the price of the share will be 143.75 in the case where there will be no dividend declaration. Now, using these two values, price of the share when dividend is declared, price of the share when dividend is not declared, using these two values we will calculate the value of the firm, and this can be presented like this. So, in the first column we have the particulars, in second column this is the scenario when the dividend is declared, and in third column we have the scenario when the dividend is not declared. So, first thing, earnings are given in the question, which is 5 lakh in both the cases. So, we have to subtract the dividend, that is we also have to pay the dividend that is mentioned in the question as well. So, the dividend paid in the first case, okay, will be 5 lakh rupees, but in second case, since no dividend is declared, so the amount will be 0 in this case. So, the total requirement of fund in case 1 will be 10 lakh, while in case 2 will be 5 lakh. So, the fresh funds that we need to raise in case 1 will be 10 lakh, because we need this much fund, but in second case it is 5 lakh, because in case 2 we need only 5 lakh rupees with us. The market price of share in the both cases we have already calculated. So, in case 1 it is 133.75, but in case 2 it is 143.75. Okay. Now, we will divide the amount that is required by market price of the share, and with this we will get the number of shares that we need to issue to raise the fund, the fresh issue that we have to make. So, 10 lakh in case 1 will be divided by 133.75. So, the number of shares to be issued in case 1 will be 7,477, while in case 2 it will be 3,478. This amount, this number of shares we got by dividing 5 lakh by 143.75. The existing shares in both the cases are 50,000 and 50,000. So, total shares after issue of new share in case 1 will be 57,477. In case 2 it will be 53,478. Okay. Now, we have number of shares in both the cases, total number of shares. We need to multiply these values by market price of the or expected market price of the share. So, in first case 57,477 shares will be multiplied by rupees 133.75, which is the expected market price of share in this case, and the value of firm will be 76,87,548.75 rupees. While in second case we have total number of share as 53,478, which is multiplied by 143.75, which is the expected market price of share in case 2, and the value of firm will be 76,87,462.50. So, from this we can see that the value of firm is almost similar in both the cases. There is minor difference, it is because of difference in the decimal or difference in the calculation because of decimals. So, the conclusion is, whatever decision you will take, whether you are declaring dividend or you are not declaring dividend at all, the value of firm will not be impacted and the value of firm will remain same. So, this is the conclusion of hypothesis. Like any other model, hypothesis also face certain criticism. It includes that perfect capital markets does not exist. Flotation cost and transaction cost, these costs cannot be avoided. Investors prefer current dividend as they have to pay tax on capital gains. So, they retain the share, the shareholders prefer to retain the shares with them. They are not eager to sell the shares because if they are earning capital gains, they have to pay taxes. So, they would rather prefer current dividend. Okay. And this model is not applicable in uncertain conditions. So, this was all about hypothesis or Modigliani and Miller hypothesis. The last one under irrelevant theory is residual theory of dividend. Now, this theory is in agreement or an extension of approach only. Now, according to this theory, external funding cannot be used for financing as the cost of financing new investment is very high, or external finance may not be available when required by the firm. Therefore, projects are financed through retained earnings only. So, whatever you are having with yourself, whatever share of profit you are retaining with yourself, you are going to finance your projects out of those earnings only. Also, retention of profit leads to an increase in shareholders' wealth because you are reinvesting this amount for the growth of the firm. When the firm is growing, the wealth of shareholders will also go up. Therefore, the firm has to decide how much to retain and how much to distribute as dividend. Therefore, a dividend decision is a passive decision and must be taken after deciding upon retention ratios. Now, since dividend decisions are passive, dividend fluctuations do not change the perception of shareholders at all. So, this is the basic conclusion of residual theory of dividend decision, which is irrelevant for dividend for valuation of firm. So, this is the brief about residual theory of dividend decision. So, with this we are going to conclude our today's session. So, we have covered quite a bit today regarding dividend decisions and the models that guide them. Now, let us take a moment to summarize and reflect on what we have learned today. So, today we began with an understanding of two major perspectives in dividend decisions, that is the relevant and irrelevant models of dividend policy. So, on one side we explored theories like Walter's model and Gordon's model, which asserts that dividend policy can influence firm's value. These models highlight the interplay between dividend, retained earnings and rate of investment. While on the other hand, we also discussed the dividend irrelevance theory, primarily advocated by Modigliani-Miller, because residual theory is an extension of Modigliani-Miller hypothesis only. So, this perspective challenges the idea that dividend policy has a direct effect on companies' valuation. Rather, it is emphasizing on the scenario that an investor's wealth depends upon the firm's earnings and investment decisions and not on how dividends are distributed. After diving into the theoretical aspects, we also applied this concept to the practical questions today, and we understood how decisions about distributing or retaining profits affect shareholders' wealth and companies' growth. I hope these examples clarify the distinctions of each model and how they function in the real world scenario. And finally, remember that these models are tools to guide decision making, but a firm's dividend policy should always align with its broader financial objectives and market realities. So, thank you for your attention today. See you in the next session very soon. Till then, happy learning.